Hello, my name is Chris Falco. I head Falco Salt's Management Advisory Services and Consulting Departments. Today I want to discuss some opportunities around stock appreciation rights, also known as phantom stock options. Nowadays, the tool more privately held companies are using to reward and retain key employees are phantom stock options. These options give an employee the opportunity to benefit from hard work to increase the value of the company without making them an actual owner. A phantom stock option is a contractual arrangement between the company and the key employees which are designed to mimic actual stock ownership. A phantom stock option operates a lot like a stock option in that the holder of the rights benefits from any increase in stock price above the price set in the award. However, unlike an option, the holder of the right is not required to pay a transaction fee to exercise them, but simply receives the net amount of the increase in the stock price in either cash or shares of the company at a defined point in time. So if you grant someone 5,000 shares at $10 each, the employee does not have to give the company a check for $50,000 for the options. The employee will only have to recognize as income, and the company will pay out any increase in the value over the $10 per share at the time of redemption. The employee benefits from the increased value of the company, doesn't have to scrape together the costs for the option, and there is no pain or complication of dealing with a stock transaction and the headaches of another shareholder. The employee only pays tax on the increase in the value that they vest in. So how are they granted? Phantom stock options are similar to stock options in that they are granted at a set price and usually having a vesting period and an expiration date. Once a phantom stock option vests, the proceeds are paid either in cash, shares, or a combination of cash and shares, depending on the rules set forth in the Stock Appreciation Rights Plan and related agreement. How are these rights paid? Well, because phantom stock options are essentially cash bonuses, companies need to figure out how to pay for them. Usually, scheduled payouts are every 5 or 6 years. Sooner is okay, but longer is not. Unlike regular stock options and restricted stock, employees cannot choose when they will exercise or redeem their shares. The business owner decides that, and while there is a temptation to push the payments out to a much later date, two negative results may occur. One is the value may compound and result in a very large payment, and the other is that employees have no way to access their money unless they quit. The cash flow constraint on the company and the loss of an employee may not be ideal results. So one final thought. Whatever you do, don't try to do this yourself. Seek out professional advice from those familiar with these programs. Most plans are subject to ERISA regulations and IRS Code Section 409A, which has some specific requirements to make these plans acceptable. Please consult with an attorney and your CPA regarding these rights, taxation rules, and the legal ramifications involved with the issuance of such rights.